Hi, everyone. This is Monique Botkin. I'm Associate General Counsel with the IAA. Thank you for joining our panel today, Trading Best Execution in the Future of Soft Dollars. I'm pleased to introduce our expert panel, Steve Stone from Morgan Lewis and Bockius, Ari Burstein from Capital Market Strategies, and Lori Renzulli from Harding Loevner. So thank you all for joining us. Today we're going to cover four main topics. We're going to go through market structure initiatives and what's happening at the SEC. We're also going to talk about Best X and the duty to seek Best X, the SEC's views, the factors to consider, policies and procedures, and disclosure, as well as some selected issues that have come up in the recent past. And then we're also going to talk about research in soft dollars and what's happening with the EU MiFID regime, as well as how the SEC is reacting and what maybe the SEC plans to do, how firms are handling the changes in the soft dollar arena with the unbundling of commissions. And then we'll touch on SEC examinations and enforcement actions and some takeaways that firms may think about as this change occurs at the SEC with Gensler coming in the near future. So I will start with Ari, and we'll turn it to you, Ari. Let's talk about market structure and what your thinking is here. What are some of the major developments that advisors should be aware of, and how might that impact their firm?
Yeah, thanks, Monique, and thanks, IAA, for having me. So, look, there's a lot of market structure developments that continues to occur. Some are regulatory-driven, some are market-driven, all of which impact best execution. Advisors don't have to be market microstructure experts, but I think maybe to take a few minutes to set the scene on some of the things that we're going to talk about later, just wanted to run through a few of the things that's happening. There's a number of issues around transparency of information. So the buy-side advisors have always been pushing for more information about market data, how orders are being routed, how they're handled, conflicts of interest, and things like that. I think the one thing to note, as many people listening in probably know, in July of last year, the SEC's Rule 606b3, or Institutional 606, so to speak, came into full effect. That adds a lot of data for the buy side to help them analyze best execution or their counterparties, gets to execution quality review, order routing analysis, conflicts of interest, even things around information leakage. I think the interesting thing is how much the buy side would use all this new information. There's been some studies out there. Some have shown that 84%, 85% of the buy side is going to plan to request these reports from their brokers, and I think most people should. And even more so that a lot of people will go beyond the 606 data and ask for more granular data from their brokers. So that's a good thing. I think the challenge is, given the large amount of information that's out there, how advisors are going to use this, how they're going to crunch the data. So there's a lot of new tools out there, a lot of platform services that have been obviously going after the advisor community to help them crunch this data. It gets to a lot of resources, obviously, for the smaller advisor. And I think there's going to be more scrutiny. So the SEC is now, looking at this. The data's out there. I think the excuses that we don't have this data to scrutinize is gone. And this was something that was asked for by advisors. So I think that's something to watch out for, and how the 606 data is going to play out. Technology also has been driving some market structure changes. We'll get into this a little bit too. The electronification of the markets continues. There's a lot more tools and services for advisors when it comes to trading. Again, I think we'll get into this, but a lot of the challenges is how advisors can utilize this. Gets down to resources, sophistication. I think we're going to talk a little bit, Monique, about outsourced trading later, and I think that plays a part into some of the new technology. Other developments, real quick, just to set the scene. The SEC recently adopted a new rule around market data. Again, for the folks listening in, I think the real point is it gets to what is core data, what should be put out to investors for free, so you don't have to buy the proprietary data feed. It also gets to the dissemination of data, the governance structure. For those of you who may be following this, like some of the other new rules lately, some of the incumbent exchanges have sued the SEC over this. So where this was going to be a 2 or 3 year rollout as it was, this might take a little longer to get in place. But I think this is really key for the buy side. The buy side and advisors have been asking for this. So that's playing into this. Fixed income, just a couple of things to note real quickly. As you see on the slides, FIMSAC at the SEC has put a lot of recommendations out there, some of their subcommittees on transparency issues, around electronification, again, of the markets. The SEC comments were just due on Monday on a concept release in the fixed income market. Not sure how many people have been following it, but it gets to some important questions about the types of platforms and systems that advisors use, RFQ, request for quote platforms and the like. And again, without getting in too much in the weeds, it gets to the accessibility and the optionality, I think, for advisors. So there's been comments that have come in from some folks on the buy side around that. So that's something to follow. And I guess just the other thing I'll add before we go on, CAT, Consolidated Audit Trail, continues to be an issue. There were a couple recent proposals by the SEC getting to security for the CAT, liability for members of the Consolidated Audit Trail, the LLC, and the SROs. Again, I think the key thing for advisors here is that it gets to data security, which has always been a key issue for folks. So again, Monique, we'll get into a lot of this stuff as we go on, but that's some of the market structure, I think, changes maybe to identify.
That's great. Thank you, Ari. So next we'll turn to best execution, and it looks like what you're seeing on here may be different from what you hear from us because we have a different slide deck, but the content will generally be the same. So next we're going to turn to Steve. And Steve, why don't you walk us through, what the SEC has said on the fiduciary duty to seek best execution, whether there have been any changes since the interpretation in 2019. And then we could talk about some of the factors and have Lori talk about, how her firm implements that obligation.
Sounds good. And let me agree that area that was really great. It's an area where there is a lot going on domestically. It's also a lot going on globally and across asset classes, and that will have a trickle-down effect on the impact of best ex and how managers approach it. But Monique, in answer to your question of if there's been changes in the past 2 years, frankly, if you said, have there been changes since 1986, I would probably say the answer is no. And so what you'll see reflected in the fiduciary guidance from 2019 is essentially exactly what you would have seen in the release from 1986 that essentially says that advisors must execute securities transactions so that clients' total cost or proceeds is the most favorable under the circumstances. When considering brokers, you have to consider the full range and quality of brokers, that it doesn't turn on the lowest cost commission, and that firms, advisors should periodically and systematically evaluate performance of brokers. So those foundational principles haven't really changed. No, but neither has the SEC's approach, either in the interpretive context or the examination context, really changed from those fundamentals.
Great. So let's talk about some factors. Let's hear from Lori. Like, why don't you talk to us about what it is that you look for when you do your analysis for best execution?
Sure. Thank you, Monique, and thanks to my fellow panelists. So first, I'm going to talk about our initial and ongoing broker due diligence process. Then I'll talk about the factors we consider when selecting and executing broker. And then I will finish up with an overview of our compliance monitoring and governance structure in respect of best execution. So with respect to broker due diligence, we only use brokers that are included on our approved broker list. And only approved brokers are set up in our trade order management system. Brokers may be added to that approved list only after they've been reviewed and approved by me as Chief Compliance Officer and our Chief Financial Officer. Our CFO reviews the proposed broker's financial statements to confirm the broker's financial stability as a trading counterparty. Simultaneously, I review the proposed broker's regulatory filings and other disclosure materials, and also samples of the broker's research to determine if a proposed soft dollar arrangement is eligible under 28E. Thereafter, updated financial information for each approved broker is reviewed annually by the CFO to confirm that the broker continues to be a viable trading counterparty. In addition, and as part of our compliance program, legal and compliance team conducts quarterly screens of OFAC and other global watch lists against each approved broker's name. Moving on to the factors that we use when choosing and executing broker for a given order. Our first priority is to seek best execution. No surprises there. In addition to seeking best execution, our best ex policies and procedures list the additional factors that we consider when choosing the executing broker, which include the broker's execution capabilities, the broker's ability to maintain confidentiality, to prevent disclosure of our trading strategy or the details of an order, the commission rates charged by the broker in comparison to the commission rates charged by other brokers for similar transactions, the extensiveness of the broker's distribution network, its ability to fulfill more difficult orders, the broker that offers the most direct route to the market with the fewest intermediaries, a demonstrated ability to execute a transaction in a particular market, region, or security, the broker's communications and administrative capabilities, including efficiency of reporting, settlement efficiency, timely correction of trade errors, constraints, if any, imposed on the firm by a client, such as a directed brokerage. And finally, again, this is in no particular order, of course, a direct access to the broker's trading desk and the familiarity of the contact person with our business. So I'm going to move on to an overview of our compliance monitoring and governance structure in respect of best execution. So we use a third-party trade cost analysis provider to monitor the quality of our execution of trade orders, as well as to analyze trade execution performance by comparing overall results with market averages over time. The TCA provider generates quarterly reports, which are then reviewed by the trading department and our brokerage and trading advisory committee. So the brokerage and trading advisory committee is an important part of our governance structure. The committee is comprised of our chief executive officer, chief financial officer, chief investment officer, general counsel, chief compliance officer, the head trader, a portfolio manager, and an analyst. And the committee meets quarterly to review brokerage-related matters, including brokerage commission allocations, soft dollars, best execution, mixed-use allocation, foreign exchange, trade errors. The committee reviews and discusses the results of the most recent TCA reports to determine if the commission rates were competitive. The committee also reviews annually Harding-Loevner's average commission rates and global commission rates using reports that we designed in collaboration with Greenwich Associates.
Great. Thank you, Lori. That's very helpful. I wanted to go back for a moment and talk a little bit about asset classes. Ari, and maybe this is something you can address. So, equity trades has been TCA, as Lori mentioned. What about fixed income and FX and derivatives? What are firms doing in the area of best execution in those asset classes?
Yeah, look, I think the factors that Steve, that you laid out, obviously goes across all asset classes. So you're going to look at the same general factors, whether it's fixed income, FX, derivatives, equities, things like that. I think what changes is how you apply those factors, so based obviously on the characteristics of the particular asset class. So some are going to be less liquid, there's going to be less transparency of information, the players, the trading counterparties are going to be different. So again, I think we might get into fixed income specifically a little bit later, but the fixed income markets are catching up in terms of transparency. They're not quite there yet. So I think advisors are going to have to take that into account when they look at best X. I think the bottom line is whatever asset class you're looking at, you're going to have to illustrate the assessment that you do on the current best X regime, looking at your counterparties and ensuring policies and procedures are in place, the same types of things that Lori laid out. I think I wanted to maybe take a step back because I didn't get a chance to kind of comment on something Steve mentioned, and I think it's interesting. While best X hasn't changed in, let's say, since 1986, Steve, I think there has been some chatter about whether there should be a look at best X, and not necessarily changing best X itself, but in the scope of the market structure. So you've seen some comments come out of the SEC. Not that this matters anymore, given that he's gone, but Chair Clayton and the Trading Markets Director Greg Redburn said several times that you should take a look at best X. I think what's interesting is Commissioner Roisman even recently said, given some of the market structure changes, maybe it's worth having some further guidance. And I think that's what it comes down to. So I don't think anybody on the buy side is kind of requesting specific guidance around best X, but there has been different chatter now that in the past without getting some further guidance from the SEC. And I think that plays into your question, Monique, when it comes to specifically like fixed income and other asset classes where it's not as clear cut as equities. I think people are looking for potentially some more guidance from the SEC. So I just wanted to drop that in there.
Yeah. Do you think that that's the case for broker-dealer best X or advisor best X, the additional guidance?
I think it probably cuts both ways. I think if there's guidance on how to utilize a certain trading venue or how a particular market structure event is going to impact trading, it probably, even if it's directly on broker-dealer best X, it probably has some trickle-down effect onto how advisors look at their trading counterparties, policies, and procedures, etc.
Mm-hmm. Great.
I don't know,
Thank
Steve,
you.
you work with the BD community more. I think, I don't know if you have any thoughts on it.
Well, look, I agree with you. I mean, I think guidance is great, but we have a long ways before I think effectively we'll be able to get there because first of all, there's segmentation in all the markets, whether you're talking on the broker or the advisor side. And the best X with one asset class, with one type of firm is very different than another firm pursuing a different asset class. And the global context also makes a big difference because Europe in many ways has a leap ahead of us by virtue of their implementation of trade reporting on both the broker and the advisor side. So they're getting systematic information that is in some ways better than what our shops are seeing domestically. Hopefully, what we'll have is a process where at some point we can all digest the changes in the landscape and the liquidity that's being developed in various markets. And as an industry, we can identify what are the issues for which we need guidance. So it's not the SEC necessarily being a volunteer here. There are particular issues. So for example, later on, I think we'll talk about cross-trading. And cross-trading can be really useful to client accounts. Yet there are questions. So for example, in foreign exchange transactions, it's not unusual for firms to net buys and sells because you save money on the spread. And so there are interpretive issues that have to be addressed. Then we can get to the point of what's the parameters of good practices and what are the points of guidance that are helpful. So I think that the market landscape change, or the changes in the market structure landscape, will make a big difference and perhaps situate us so that we will be able to have that dialogue.
Yep. So let's talk a little bit about, did you have
sorry,
something,
Monique.
Ari?
You know, a lot of the stuff around transparency and what Steve brought up and we talked about earlier is around helping advisors have that dialogue and a better dialogue with their counterparties. And I think, you know, maybe we'll get into this a little bit more, but I think that's a key thing that folks may not focus on a lot, is sort of the questions that they should be asking of their counterparties.
Well, why don't you just go ahead, Ari, and talk about that now, because I wanted to move to some selected issues under Best X, including zero commissions and payment for order flow, as well as outsourced trading. But before we get to that, why don't we talk a little bit about some suggestions that you have on what advisors can ask their counterparties? What should they be doing, and in what instance should they consider switching a broker counterparty, and maybe some examples of you know, ways in which, you know, new market entrants can get in front of advisors, and what are your thoughts on that?
Yeah, I mean, look, we already talked about a lot of the factors. You know, I think, Lori, you had a great list of the things that you look at, and you touched on it. I think it comes down to obviously looking at the range of services that are out there, and you noted a bunch of the things that go into a range of services. So execution capabilities, opportunity for price improvement. I think if you're a larger advisor, you know, how to trade, how folks handle large trades, that's really important. You know, how fast they can execute, obviously bringing in the best price at the same time. Confidentiality of trading information, that's huge. I mean, we've seen some enforcement actions around that. You know, financial responsibility of the counterparty, technology, the ability to process the trades. You know, I think in addition to kind of the range of services, as we've kind of alluded to, looking at conflicts of interest and how you identify that with your counterparty, and some of the transparency comes into it. I think to your question, Monique, you know, there are a lot of these new trading systems and counterparties that are out there. I think the struggle that they have, if you talk to them, is, you know, when an advisor is looking at their broker lists, and again, Laurie, I don't know how often you change your, you know, have really in effect changed some of the folks on your broker list, and you're shaking your head. I think that's the answer we get from a lot of folks, is that particularly in this environment, you know, it's hard for some of these new innovative trading systems to kind of get on a broker list or get on an OMS system at an advisor. So again, I would just say, you know, be open to kind of the new technology that's out there. If your traders, you know, don't really speak to some of those folks, I mean, you know, you can kind of go out and find them, or there are people who will hook folks up with them. But there's some really interesting ways to trade now that can have cost savings for advisors. And I think if you go down that list that Lori said and you scrub them in a really effective way, you know, there are some good tools out there, if that answers your question.
Yeah, thank you. So let's talk about some issues that have come up recently. The move to zero commissions, and Steve, maybe you could talk about this. How does that impact an advisor's analysis in terms of its, you know, Best X duty, and also soft dollars, which we can cover a little bit in a few moments when we talk about soft dollars, but there is a question from one of the audience members about how that impacts the ability to use soft dollar arrangements. So what are your thoughts on zero commissions?
Well, I guess the pricing of commissions is always a consideration that firms should consider. And so, frankly, zero commissions is not a new phenomenon. There are institutional managers who have been paying zero for certain order flow for quite a period of time. So you need to consider the prices that firms are charging relative to the services they provide. And just because you pay zero in commission doesn't mean you are going to get qualitatively a superior execution by other measures. And there's long been commentary from various academics that the commission is the proverbial tip of the iceberg. And you really look at other concepts like implementation shortfall to evaluate qualitatively how you did on a given execution. but it's a point of consideration. But you also have to understand economically how firms get to payment of a zero commission. That is how brokers get to that point. And that could mean that they're getting payment for order flow, and that could have an effect on their decision to route orders to particular markets without regard to how those markets are performing. So it creates a conflict. That's a conflict that brokers can address, but it does warrant some consideration. There also is the fact that a broker may be willing to take an order for zero commission on one side because they expect to get the trade on a commit and get a commission on the other side. So understand, what is the charge? Realistically, there's a different approach in both retail and in institutional on how commissions are approached. And often it's the case that firms don't differentiate commissions across the broker list. They differentiate the commission by the type of execution, be it low touch or high touch. And if they hit a certain level based on research that, as you mentioned, they may go to an execution only rate. So I think that zero commissions is kind of a red herring of sorts. And it really comes down to how you determine what you're going to pay a broker for a commission, recognizing, and this goes to your point you made about research, is that under U.S. law, a money manager is entitled, will not be viewed as having broken the law or breached their fiduciary duty by paying a broker a little bit more in the form of a commission if they think it's reasonable for the research and brokerage services they get from that broker-dealer, viewed in the context of the overall relationship for accounts they have discretionary authority over. So a factor for consideration. But I think the other end of this is really the payment for order flow angle, which has come much more under scrutiny in the current environment for advisors, but also for dual registrants. And this is an area where we see firms that are revising their practices, revising their disclosures. The concept of payment for order flow is a bit of a nebulous concept. It's defined, ironically, in the broker-dealer confirmation rule, and it's essentially a payment in exchange for routing orders to a venue. And there's some payment for order flow arrangements that are purely just that. You send orders, you get a kickback, the broker gets kickback for certain of the trading charges, and it's computed in different ways. Then you have maker-taker arrangements that Ari knows a ton about, I know a little bit about, but essentially a broker-dealer pays for taking liquidity out of the market and receives compensation for bringing liquidity into the market. Ultimately, that's a pretty efficient way to drive liquidity into various venues. But to the extent that a broker has a conflict in their venue or broker selection or counterparty selection, it's something that should be considered.
So it looks like Gensler is planning to, and he's been asked by Congress to look at payment for order flow. There's been other calls to ban that practice. Ari, what are you seeing in terms of what brokers are thinking? Is this something that is at risk of being eliminated, this opportunity for them?
Yeah, I mean, look, I think we're a whiles away from it getting eliminated. I think there's a lot of debate to be had before that happens. I think just a couple of things to be clear. I mean, there's been a lot of talk about payment for order flow over the last few weeks, and even with the GameStop hearing a week ago, I guess now. Look, it's legal, as Steve said. It's transparent as long as you're disclosing it, and it's something to take into account. I think what it comes down to is for those who have been following it, I mean, the argument is the retail investors are benefiting from payment for order flow, and that's been some of the argument. On the flip side, I think from an institutional advisor standpoint, I think from folks I've been talking to, people are mixed about necessarily what to recommend here, and I think we'll have to kind of see what's out there. I think the other argument about payment for order flow, and it gets to exchanges versus brokers versus buy side, is how much this has pushed liquidity off exchange. And again, this is sort of outside the scope of this panel. It gets into geeky market microstructure topics, but we crossed a threshold recently that some of the audience may not know, that we hit over 50% of the volume is off exchange, so in the dark. And I think that was just a psychological barrier that we hit, that I think brought up again these issues of does that impact trading for advisors, liquidity in the markets, pricing, price discovery. Are you truly getting executed at the right prices? So look, I think payment for order flow, the debate's going to be one for the next first half of the year, if not longer. I think at the SEC, where market structure and trading was not going to be a hot topic, it was going to be ESG and Reg BI. I think market structure is going to be back in the spotlight. I think a little bit, but yeah, we'll.
Yeah, I mean, I think, Lori, that's an interesting question. Thank you, Steve and Ari. How does your firm look at where the trading is done? Is that a factor, and how does that play into the selection of the broker for your traders?
Well, Monique, we look at all the factors that I listed, but which broker is particularly adept at executing or settling in foreign markets, particular foreign markets. Well, this broker, this niche broker is very good at settlements in Russia. So that's something that we've learned over the years. Which ones are better at different aspects of a trade.
Okay, thanks. We have a question, Lori, from an audience member, and they're interested to know how you can run a better Best X meeting. So maybe do you have any guidance on sort of some takeaways to make sure firms cover in their meetings, and preparation ahead of time, follow up? What about during the meeting?
Sure. So our best, and I'd be happy to share a form of agenda offline to the person who's asking the question. So we built a framework for the Brokerage and Trading Advisory Committee to put under one umbrella all the different trading aspects that I listed earlier, and we have a formal meeting. Well, if we were in the office, we'd be around a conference table, but we have a formal quarterly meeting, and there's a lot of prep work that goes into in advance of the meeting to assemble the not only the TCA reports, but also to analyze them in advance. And so our traders come prepared to discuss what the outliers were by market or by broker or by region, and say, oh, well, that was a trade that took a long time in India with this one particular broker, and that's why there's a spike in that commission. So what we do when we have these meetings is we discuss the outliers, and we set thresholds in advance as part of the committee framework, and we will go through each of the thresholds, and it's minuted. So each of the items in the agenda is addressed in the minutes, which are saved. Books and records saved with the the committee meeting pack, and then we review it in advance of the next meeting to see what are the open items. But the chairperson of the meeting, who's our CFO, will circulate immediately after the quarterly committee meeting. Say, here are the open items, here are the follow-ups. And the individual responsible will either, for example, reach out to the TCA provider because we need them to rerun a report, or there was an item that was mistakenly excluded, or something needed to be corrected. And so all of that goes into the record, which will, as we all know, be produced in the event of an examination.
That's great. Thank you, Lori. So one audience member wanted to know, what is the size of your firm and how many brokers you use?
So We are over 80 billion in assets. We have 106 employees, and our list of approved brokers is somewhere around 35. And just comment to pick up on what Ari noted earlier is that number hasn't changed. It's been like +1 or -1 or over the years, but it's very steady number at around 35.
Great, thank you. So let's switch gears and talk about outsourced trading. I know that Ari and Steve both have experience and thoughts on this. So Ari, why don't we start with you? What is the trend in outsourced trading, and do you see that taking off even more in the future?
Yeah, so look, outsourced trading is kind of one of the hot topics lately. I don't see it slowing down at all. If anything, from the outsourced trading firms I've been speaking to, they are growing globally. They're growing in clients, and both small and large advisors. So I think that's an important note. I think where at the beginning, and when people think of outsourced trading, it's, hey, we have one trader, 2 traders, 3 traders. We either want to get rid of our trading desk to save costs, so we're just going to completely outsource, or we want to, knock 1 or 2 out. That's fine. I think more and more very, very large advisors are using outsourced trading. I think just for scalability, I think it does come down to, should we build out this technology internally or rely on an outsourced trading firm? So I think if you're deciding whether to use outsourced trading firm, I think there's probably a few things that an advisor should think about. Let me kind of maybe talk about 3 or 4. One, I think, look at whether your outsourced trading firm is independent or not. Are they affiliated with a bank? Are they affiliated with somebody else that has ties to a broker dealer? Are they independent? I think that's important. And I think, it's important for folks to do their due diligence around that. So, if you're affiliated with a bank, are there conflicts of interest around how they route orders? And I know there's a lot of bank affiliated outsourced trading firms kind of jumping into the fray. How experienced are the traders? What's the technology they use? Again, if you're going to outsource, just make sure that the outsourced trading firm look at who their traders are. Did they come from senior positions in the buy side, sell side? Again, what's the technology they use? To the extent it's relevant, how do they deal with research, commission management systems, things like that? Can they handle that? Again, to the extent it's relevant, how do they manage the full trade cycle? So from execution through to clearing and settlement. So I think those are some factors to look at. But again, I think in general, there's been a lot of cost savings that can be had through outsourced trading. It does bring up some best execution questions too. And I guess maybe Steve, I'll turn it over to you if you want to address some of those.
Yeah, I mean, Ari, I totally agree with you. And for many shops, you would say we're not possibly going to outsource trading. We have our traders over here. It's a team. They work together. They're in sync with one another. They're aligned with the architecture of our PM teams, and it works. I think that the pandemic has really changed a whole lot. And so it's gone from outsourced trading really in the sense of affiliated managers having a joint trading desk to a situation where firms are actively thinking, if they haven't already migrated to outsourced trading, again, precipitated by the pandemic. I think that there are lots of different issues that firms should consider depending on the circumstances. And just as outsourcing was not something that existed in 1986, you're not going to find SEC staff guidance on the issues that you should consider in outsourced trading arrangements. I think, Ari, the points you raised were all good ones in terms of independence, conflicts, diligence, expertise, handling and research. I would also add to that list approach to material non-public information, information barriers, beneficial ownership reporting, purposes of 13 FDG, access person status, who has discretion from a 2080 standpoint. So under 2080, the SEC has taken the position that you can only rely on the safe harbor if you have investment discretion, including the discretion to choose brokers. So think about how outsourced trading may change that dimension. What about sharing of research across the clients who are using an outsourced trading desk? Same sort of concept comes up with trade aggregation and allocation. So for example, if you have multiple firms whose orders are aggregated and scaled back in a partial fill, is that what you're disclosing? I think we've talked about conflicts. The last thing is there's some outsourced trading desks that really are part of an advisor. And if they're doing that for compensation, that may make them a broker dealer. So there are a fair number of issues. I think that this is going to gain more traction. And I wouldn't be surprised if in the course of this year, you'll see some major players who are physically taking their trading teams and moving them to an outsourced provider so that they'll have continuity with the professionals they deal with.
Yeah, and Steve, I guess it's not only in the equity space anymore. It's really taking off in fixed income and derivatives and FX as well. I think even more so than on the equity side.
Even more so because those tend to represent a smaller piece of any given manager's business. And so they may say that we're not going to dabble in having one guy who's going to just do FX or fixed income if it's not central to their business.
Yeah.
So how would the outsourced trading desk be, you said they would be considered a broker dealer or an investment advisor?
They could be viewed as both.
Okay. So that's a very interesting arrangement, and one that I think that we'll definitely explore further. Lori, what do you think about outsourced trading? What are your views on pros and cons, and why would a firm engage in that type of arrangement, and why might they not want to?
Sure, thanks, Monique. So, well, I can't speak to trends in outsourced trading. I can speak to, or just throw out some considerations to add to the ones that Ari listed and Steve listed. So I had very interesting conversations with our CEO and our CIO when I asked them this question. As with most topics in our industry, apologies in advance, the answer depends on many factors, and one size never fits all. So the two considerations that I took away from those conversations when firms want to think about outsourced trading is scale and focus. So trade order management systems are very technology intensive. Straight through processing, settlements, and accounting system is very complex and expensive, as are the data links. And smaller firms may find that it's cost prohibitive to have a state-of-the-art system in-house. I'm talking not just the cost to purchase the system, but also about the implementation and ongoing maintenance as well. So there's different types of management to consider. There's technology management, personnel management, risk management is overarching for all. The types of securities a firm trades is going to be a factor as well. So are the securities plain vanilla and US based, or is the firm trading foreign securities, fixed income securities, and or derivatives? Another factor to consider is the firm's pre- and post-trade compliance responsibilities and the level of sophistication needed in the trade order management system to ensure that those responsibilities are met. Also, are any of your client accounts denominated in foreign securities? So how is FX handled? If the firm is handling FX in-house, that process needs to be integrated into the order management system. Also, is the firm trading in real time in foreign markets, or does it hand off orders to brokers at 5 p.m. and see the fills in the morning? If the firm's trading in real time, that greater level of control that the firm has decided to keep means multiple trading shifts and the need for 24/7 technical support. I can't speak to the different firms or providers for outsourcing, but I would expect, and Ari and Steve can of course chime in, is that those service providers already have the scale and support systems in place, so that might be appealing to a smaller firm as a result. The more you trade, the more you pay to the outsourced providers. So if a firm opts in for an outsourced option, the threshold at which it makes sense to bring it back in-house, needs to be monitored. And I'll just say one other quick comment about focus. So what I mean by that is not a question of the size of the team, but rather the depth of the team. I think Ari and Steve, picked up on that. The traders are one part of the equation, but you also have to include the knowledge depth of both the management and the compliance teams as well. So whether a firm elects an in-house trading system or an outsourced option, there needs to be compliance oversight and management support either way. So the professionals with the appropriate skill set must implement effective oversight, regardless of which option you choose.
That's great. That's very helpful. Thank you. So Ari, did you want to add anything about outsourced trading?
Yeah, look, I think the only thing I'd add is, and I don't think we've touched on it, outsourced trading firms obviously will do their own TCA, transaction cost analysis for firms. So I think that's another thing to look at. How robust is their transaction cost analysis? What systems they use to crunch the data, and how robust is their TCA reports that they give back to an advisor. So I think that's important, and actually, that can have real, again, cost savings. We haven't talked a lot about some of the specific cost savings, but the bottom line is you save a couple basis points here or there. It adds up to a lot of money at the end of the day. So
that's great. Thank you. So before we switch to soft dollars and research, Steve, there was a topic that you mentioned earlier in our panel, cross-trading. So the SEC in the valuation release applied a new definition to the cross-trading rule, and for the definition for readily available market transaction data. And I'm just curious to know if you can explain to us, explain what the SEC has done and how that impacts the ability to cross-trade, in particular for fixed income securities.
Sure. So the securities laws are kind of odd in how they approach cross-trading. And so you have cross-trading under Rule 17A7 of the 40 Act, which is what we're primarily talking about here. But there's also cross-trading provisions under the Advisors Act, Section 2063, where you need to get client consent if you're acting as a broker. We're doing an agency cross-transaction. And those two frameworks have never actually been compatible. You can't comply with them simultaneously necessarily. But in the context of the 40 Act, there has been a focus on the circumstances under which, consistent with 17A7, you can do cross trades. And there were a limited series of letters, one to Federated. We're in the context of municipal securities transactions. The SEC had signed off an approach of using indicative or prices or pricing services because 17A7 otherwise is looking for an actual quote or last sale price. And the SEC a year and a half ago had done large-scale firm engagement to understand cross-trading practices and spent hours with firm after firm interviewing them, getting their perspectives on how they use cross-trading, the changes to reform, as well as kind of approaches on valuation. What they came out with was a framework on valuation, which they decided to extend to 17A7, which essentially forecloses using pricing services. At least that's how firms are interpreting it. It's not clear why the SEC took that path. That's perhaps a backstory that I think that we'll be looking to get. But it does have firms concerned on how it affects the ability to do cross trades, which ultimately can save money for clients.
Right. And I think, we did hear Sarah Ten-Seetoff talk earlier with Gail Bernstein about this being an issue for the division. It is on their Reg Flex agenda. We do have a registered funds panel with Brian Johnson tomorrow who will also cover this topic, but it is definitely something that the industry is engaging with the SEC on to make sure that they understand the importance of the flexibility that's currently provided and the impact of the interpretation on cross-trading in the fixed income space. So, Ari, speaking of fixed income, did you want to mention anything else about BestX for fixed income before we move on to research?
No, look, I think in the interest of time, well, I know we have a couple of topics. I think we pretty much covered,
Okay, great.
The basics.
So let's turn to soft dollars and research. There have been significant changes in the past 4 years regarding the use of client commissions to purchase research. And Steve, as you know, you were involved in getting the relief from the SEC for no action relief so that firms could comply with the EU rules under the MiFID regime on inducements. And maybe you can just share with the audience what's happened since those no action letters have been issued. You know, the extension is until 2023. What will the SEC do in light of the changes in the EU? And, you know, what should firms be looking out for at this point?
I think the short is for, news that the EU has transposed the legislation into the member state rules. So maybe to step back for a second. So a couple of years ago, as many would know, but just to backfill, Europe put in place limits on inducements, which included research. And so a broker could not provide research other than something that was a minor non-monetary benefit. And managers couldn't receive research except in circumstances where they paid for it out of their P&L, or they paid it out of what's called a research payment account, that essentially is an account that's funded by client assets used to pay for research. And so it radically changed the research environment in Europe. After a year or so, it became clear, and it was accentuated by the pandemic, that research coverage was really diminishing for fixed income research and for small and medium enterprises. And so there have been a push in some of the European states, including France and Germany, to relook at the MiFID restrictions. Ultimately, the way the EU decided to go was to not provide a break on fixed income research, because there was neither interest on the buy side nor the sell side to have that change, but really to focus and to limit it on SME research. The result is when that change in MiFID goes into effect, that is when it introduces legislation at the member state level, we'll have to modify the SEC's letter, because the SEC's letter to the securities industry says, don't worry about getting a check for commission for research. That won't make you an advisor if the payer is required to pay for research in that way under MiFID. So it's really limited to firms who are domiciled in Europe. So it'll have to be modified. The SEC staff has throughout this process been in consultation with the EU representatives. And I think as things progress, we'll have some tuning up of the SIFMA letter to address that. Whether we will push back even further the 23 expiration of the larger letter, we'll have to see.
Great, thank you. So Lori, I know your firm is not subject to MiFID directly or indirectly, but yet you've been impacted greatly by the unbundling of commissions, and yet you're unable to pay brokers cash for their research because you can't fall under that exemption, that no action relief. How
That's
has
right.
this environment affected your use of soft dollars and your client commission arrangements?
So, as you pointed out, we are not subject to MiFID, but we were paying very close attention to those shifts in the regulatory landscape, and we took steps in advance to get a better handle on our research use, management and analyst meetings, and our consumption of them. So we have for decades pushed brokers for pricing transparency, and then we used MiFID as an opportunity to advance those objectives further. So in 2019, in anticipation of the possibility of MiFID type changes coming to our shores, we advised each of our sell-side brokers that we would no longer use bundled commission schedules and would thereafter trade exclusively through CSA arrangements or at execution-only rates. We migrated our research usage tracking into a third-party database and required brokers to enter their meetings in the database as well for matching purposes. This greatly refined our oversight, which was already robust, of the entire research process. It was a worthy endeavor for the firm because it refined our research consumption tracking and our demand for pricing transparency from the brokers. Our chief investment officer made the observation to me that MiFID, and Steve, feel free to disagree, MiFID seems to be losing steam in the EU as the EU pivots toward ESG and climate change issues. But my firm has the framework in place in the event that the SEC and Congress decides to take on a MiFID-like initiative. So based upon the SEC's exam priorities published yesterday, they too seem to be focused on ESG matters and climate risks. So just my opinion here, but I doubt there's much appetite at this time for proposing MiFID-like change. But my point is we'll be ready, and we put that framework in place in 2019.
That's great. Thank you for sharing that. So we have just a few more minutes left, and we had another topic we wanted to cover. And Steve, I'm going to turn it to you. So exams and enforcement, what can you share about what you're seeing your clients going through in exams? How can they be prepared for the SEC to come in and analyze the trading patterns and the trading data that each firm has? And then what are maybe a couple of enforcement actions and takeaways you can share that have been recent with the audience?
So Monique, I think as firms prepare for exams, you have to be prepared for the notion that the SEC has a fairly impressive arsenal when it comes to data analytics. And they have teams of data scientists that work with the examinations, that is the Division of Examinations team, to come up with ways to tease out of the data that they're grabbing a lot of analysis to detect irregularities or issues. And so they've had this, I think, since 2012. So we're in like 4th generation of NEAT. At some point, hopefully the SEC will release more information than they have on the specific tests, but they do look at things like cross trades, tradeaways, advisor or employee front running, or having personal trades priced more favorably, principal trades, affiliated transactions, and a dozen or more other testing. For the examiners have it essentially on their desktop. It's like a Excel-like functionality that in real time, after a firm coughs up, uploads a terabyte or two of their trading data, and it gives them a quick result of the aberrations or irregularities. There are very few private sector tools that cover that. And so I think firms have to really grapple with the fact that unless they have sufficient resources, they're going to have a surprise when the SEC identifies trading issues that were not on their compliance landscape. In terms of the enforcement cases, and given the time, I think the enforcement cases typically have followed on these traditional concepts listed on the screen, and there hasn't been a lot of changes. And what we typically are urging clients to do is focus on disclosure. So say what you do and do what you say. And a lot of the enforcement cases comes from lapses in disclosure, perhaps not intentional ones. So for example, there was a cross-trading case where a lot of the cross-trading was not a problem and could have been done consistent with the law, but the firm had policies and procedures and disclosure that said, we don't do cross-trades. Okay, well, but they did do cross-trades and the disclosure was off base. And also take a look at the disclosure insofar as many firms will have a listing of the factors that they consider in broker selection, whether generally or in particular transactions. Make sure that makes sense. And often it's drafted by lawyers, and we think let's pull all the factors together and put them on our disclosures. Well, but if they're not actually current issues that we look at, they're going to be a source of trouble.
That's great. Thank you. And just to add one more wrinkle to the discussion, the SEC issued a risk alert on digital asset securities, and also talks about their portfolio management, custody, and record keeping in terms of trading platforms for digital asset securities. So that's another area to take a look at if that's something that your clients are looking to invest in. So we have reached the end of our hour, and in the interest of time, I'll go ahead and conclude, but I wanted to thank Steve Stone, R.A. Burstein, and Lori Renzulli very much for participating today. Thank you all for joining us.